Starting with the 620 credit score is our minimum to get pre-approved nowadays. That can change at any point. That is a guideline that the industry standard is set at right now, currently. But in previous years, that has been as low as a 580 for FHA. And so we can see that there's potential for that to go back down. But right now we're starting at the 620 mark. If you are below a 620, there are ways to get your credit score improved. Typical turn times, depending on how much we need to improve it, could be anywhere from 1 to 3, 6 months, just depending. But different products are going to be more appealing to that client at the 620 credit score versus someone with a 700 plus credit score. All right, so you're pre-approved with your lender. You're coming up on your credit expiring, which credit is good for 90 to 120 days during that pre-approval process. So what do you do now? Your next steps are definitely to reach back out to your lender and ask for an updated pre-approval. As long as there are no credit changes, meaning again, new car purchases, boat purchases, multiple credit cards opening, things like that, or as long as there's no income or employment changes that we need to make note of, the pre-approval will basically stay the same. What we will update again is your credit report, just pulling that new report that's fresh, and we will update your residential history, employment history, and things like that in the file just to make sure that everything is very streamlined and up to date. It does not affect your credit in order for you to re-pull credit, because mortgage hard pulls, again, do not knock credit. It is gonna show inquiries within the past 120 days. So sometimes that can show up on your report, and you might have to answer about that, say you do go under contract. But that's a simple question of saying that it was mortgage shopping, mortgage related. So again, it's great to go ahead and get that pre-approval updated, especially in a rising rate market, just to make sure that as you are offering, that you're still actually pre-approved for that purchase price. The interest rate can affect your qualifying and your purchasing power. When the interest rates over the past 3 months have gone up 2%, that does disqualify some clients from maybe what they originally were approved for to nowadays. So keep that in mind, that checking back with your lender, seeing at that purchase price what the rate is today, making sure you're still qualified before making those offers is very important, and great conversations to have even weekly with your lender to see where everything stands. And also just keep in mind that what goes up must come down. So it always works that interest rates rise, then they do fall back down. And so if you do need to purchase now and you feel like the interest rate at 4, 5, 6% is super high, keep in mind that the option of refinancing in a couple years is going to be there, where you could then shave some money off your monthly payment and get back down to an interest rate that you feel comfortable with or that you maybe expected.